Hi, guys. Welcome to the How I Raised It podcast, the show where you get an inside look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Zach Coelius of Coelius Capital, an early stage venture fund that's invested in dozens of startups from Cruise to HelloSign to Mudwater and many others. In this episode, we go deep into how he got started angel investing and how he leveraged that into becoming a solo GP venture fund. We also talk about how to get access to deals, how to be useful, how to do leveraged favors, and much more. If you're tuning into this podcast to learn how to raise capital for your business, I've created a super valuable free welcome package for you. It includes a list of 2,500 investors who don't require a warm intro, plus 200 questions that investors are going to ask you. So this is really going to help you prepare to raise money. To get instant access to this, click the link in that first comment. While you're there, please leave us a nice comment. Hit the like button. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Zach.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have Zach Coelius of Coelius Capital coming to us from Bernal Heights, San Francisco. How's your day going?
Good, man. How are you? Good to see you.
Good to see you. I saw you at your dinner a couple of weeks ago. That was fun. I like that you
Thanks
guys
for coming. Thanks for coming.
Let's start off with, what do you do? What is Coelius Capital?
What do you say you do around here? So I like to say I'm a washed up entrepreneur. Spent 20 years starting companies, never really had a real job. And then we sold the last one in 2015, which was an ad tech retargeting business. Crazy 10-year journey. I washed up on the beach that is being a VC. And so I've been investing in startups ever since. So I spend all my time running around talking to startups, helping them out, give them some money, pray for them, pray some more. Just the startup journey, but on the other side of the hellscape that is being a startup founder.
I like it. Is it easier or more fun? We'll get into a lot more details, but
yeah. It's at least 10 times easier, maybe more. Yeah. I have this analogy I love to use that it's funny. Somebody actually ripped it off and used it on a podcast word for word. It's like I've been using it for years, but like being a startup founder is a lot like being like, have you seen the movie The Gladiator with Russell Crowe? There's a scene in the movie very early where he's captured and it's him and a bunch of slaves. They're in the base of the arena, and they're about to be pushed out to the middle where they know they're going to get chopped in half, which is like a fucking terrifying thought, right? Like imagine you're in front of a door and on the other side of it, you know, there's a pissed off dude with a battle axe. So, like grab whatever weapons you can grab and you go out in the middle, and being an entrepreneur sort of like this. Like you get your team, whatever you can get, you get whatever resources you have, and you go out in the middle of the arena and you fight and you sweat and you bleed until you die, which is what happens to almost everybody, or you exit. And it's like, you can claim you sleep as an entrepreneur, but like in reality, you don't. You just fight and sweat and bleed. And the thing is that like every problem you solve, you immediately escalate to the next harder problem. So it's just like, and it's a rocket ship ride into the walls of whatever your own personal incompetence is. So all the things you're good at, you quickly beat the bad guys, you move forward, then they send 2, you beat them, they send 4, you beat that, and like suddenly they're shooting arrows at you, and there's tigers on chains, and it's a never-ending escalation of the problem set. And being a VC is literally like being one of the douchebags in the stands who bets on which gladiator is going to win and which one's going to die. Like it's so much easier. And I used to be an entrepreneur, so I love to run in the middle and help out a little bit and be like, hey, let me help. Pretend like I still know how to be an entrepreneur, but like, pretty quickly I'm like, my beer's getting warm. I got to go back. Like, good luck with this. So yeah, being a VC is a much, much, much easier job. Less fun, but easier.
That is a great metaphor. I love that metaphor. I have never heard that one before. So whoever borrowed it from you hasn't made its way into my orbit, but
good,
I love that.
Good. That guy's a jerk.
Okay. No, that's good though. Okay, well, let's go back to kind of the chronology. So you had your startup, you exited, and then you just, I guess my question really is, how did you become a VC? But I think let's pick it up after exiting. You started doing some angel investments, right?
Yeah. Well, so what happened was is that I'd always been very active helping other founders raise money because I enjoy the fundraising process, and like it's the ultimate sort of win-win. Like if you can introduce a founder to a VC and the VC funds the deal, then everybody owes you a favor. The entrepreneur owes you a favor, the VC owes you a favor. It's like it's a beautiful place to sort of sit and add a lot of value connecting the right people. And so I'd helped a lot of people raising money in my years and advised a bunch of companies and just sort of been active with other folks. And there was a company that I had been working with called Branch Metrics, and I had introduced them to their seed investors. And then NEA was leading the A, and this was like January 15. And I was like, hey, you guys mind if I put this up on this new angel list thing and syndicate it? Which is like, at that point, it was very, very new. And they were like, sure, knock yourself out. So, I wrote the memo and put it up. And 24 hours later, I'd raised, a couple $100,000. And I'm like, look at that. I'm an investor now. I mean, it was total happenstance. And so this is while I'm trying to figure out what to do with my life. We just sold the company, and like, I wasn't going to be involved with the company going forward. So I was like, I didn't know what the fuck to do. I was like, so that year, while I kind of got my stuff figured out, I wandered around and made a couple other investments. And one of them was Cruise. So when the Cruise exit happened, everyone suddenly thought I knew what I was doing. And the momentum started, and AngelList momentum started. And so all these feedback loops started kicking in, and it just started growing really, really rapidly. And like, long story short, now I run one of the biggest syndicates on AngelList, and then I've raised a number of funds, and then I work with a bunch of LPs. We have SPVs together, and so there's a bunch of capital now that I manage. But it all started with just sort of stumbling into it, and
yeah, I like it. So let's keep going, because I think it's always interesting to hear how people end up, in the VC chair. But were you doing direct investments with your own capital, or were you mainly putting together syndicates, getting other wealthy folks to basically back, and you're taking your carry, or what?
Yeah. I've never invested for my own capital. I never had much capital to play with, and that in retrospect, I was there at the very beginning of Uber, Airbnb, Dropbox. So like 10K checks would have done some pretty awesome things there, but I wasn't doing that. So no, I was all other people's capital. I put in a little bit of my own into each deal, but effectively other people's capital via the syndicates, and then eventually via the funds. I have my own capital, much more of my own capital at risk. But in the beginning, it was like I would literally write checks for $1,000 per deal. Like, and I would send a note to my LPs. I'd be like, hey, I know this looks weird, but I actually don't have a lot of cash. Like, and I'm still very illiquid. Like 90 something percent of my net worth is in startup equity. So illiquid and highly volatile, which is just fun.
Interesting. If you don't mind, for anyone who's not familiar, how does the syndicate model work? So basically let's say you find a company, Acme SaaS, whatever it is.
Yeah.
And you talk us through it in real simple terms, how you put together a syndicate. Yeah.
So on AngelList, which is where I do most of my syndications, anyone who's a accredited investor or you can join AngelList. You sign up there, you verify that you are eligible to invest in startups, and then you get to see all of these syndicate leads, people like me, and you just click the buttons and you back them, quote unquote. In reality, that just means you get on the email list and you get to see the deals, and there's no obligation, no commitment. It's very much like you're just along for the ride. There's 5,000 people in my sort of list. And then when I find a deal that I want to invest in, what I'll do is I'll carve out an allocation that I'm going to put up on AngelList. So call it a 200K allocation. And then I'll write a memo. This is the deal. This is the terms. This is the lead. This is all the reasons why I like the company. And then I'll share that with those people. And then those people individually can choose to participate or not. 5,000 people on the list, on a regular basis, we get maybe 50, 60 of them, sometimes 100, but usually like 25 to 50 people will opt in. They'll put their capital into the SPV that makes the investment into the company. And then I get carry on that. So if we sell the company and make them more money than they invested, then basically I get a carry check out of that, which is nice.
So, yeah. And is it like 2%, like a typical venture?
So that would be normally a 2% fee. It was a 15% carry. Normally you'd have a 20% carry. But in this case, I take a 15% carry.
Got it. Okay. And you're putting in a little money, whatever it is,
Yeah.
or something, and it's essentially that carry is rewarding you for finding the deal and pulling together all these other
Doing all the work.
Yeah.
I mean, there's a lot of work from the initial deal flow, sourcing the deal, finding the deal, getting into it, deciding to do it, negotiating, managing it afterwards. I mean, there's a lot of work that gets done in the life cycle of an infinite angel investment or early stage investment.
You started doing that, I think you said 2015-ish. Is this still a viable strategy for, let's say someone just got out of a tech firm, they've got some money. Should they just start angel investing? And maybe they want to become a VC, right? They want to raise a fund eventually. Should they start doing syndicates, or should they just start angel investing directly?
So syndicates are, the challenge with syndicates is that there's a lot of people who syndicate a lot of deals. So the people who are on there, they see all these deals and they're trying to pick which one to do. And the challenge is how they figure out which deals to do or not do. And so the real secret is, until you've built a track record that you have big exits and people think they know what you're doing. The real secret is to do deals that have VC leads. So if Sequoia is leading a deal, or NEA is leading a deal, or Andreessen, or Benchmark, or any of those folks, and you get an allocation alongside them, great. Then people will invest in that deal because they trust the VC lead. And so, like, for instance, when I first started doing it, no one knew me from anything, but like my first deals were NEA, and then Spark and Rakuten, and a whole bunch of other top tier firms. So people were investing behind the firm less than me. If you can get those sorts of allocations into those deals, then you can do very well. If you don't have that, it's basically impossible, because the noise on there is very significant now.
And that's kind of was the subtext of my question too. Like, is this still a strategy that you can do? Because AngelList is interesting. I mean, we even raised a little money on AngelList back in the day, and I don't think you can go on and do it like that, like we did it. It's changed, right?
Yeah. The self syndication thing. I mean, maybe it might happen. I don't know. I don't sit on the other side of the table on AngelList. I don't know what's happening on there, but yeah, it's evolved quite a bit. But really, at the end of the day, it's about, the secret is getting allocation to deals that have strong leads. Then you can get other investors to join you in that, and then you can get carry on their capital.
And if you can't do that, I mean, to someone who, again, kind of wants to become a VC, do you recommend just, hey, hustling like crazy, make lots of intros, be paying it forward, and writing your $25K check into deals you can get access?
Yeah, I mean, it's a hustle. That's one way to do it. The other way to do it is just like spend your time trying to figure out how to get access to those allocations. Because once you get those allocations, then everything else becomes a lot easier. So even if you're not using AngelList, you can get other people to invest alongside you. You can do a lot of interesting stuff.
Let's talk on that just for a second. What are sort of the top 3 ways to get access to allocations? Obviously,
there's only one way.
Sorry, go ahead.
There's multiple ways, but there's one way that really works. It's make friends with founders. If you help founders, like if you're there helping them, if you're making it, like for instance, if you introduce a founder to the VC who invests in the deal early on, that's how I would get a lot of my allocations. Then, they would be pretty uncool if they didn't give you an allocation in that deal. If you're there helping them with, hiring, recruiting customers, if you're adding value to the business, then you can get allocation. But there's another strategy, which is you go to the VCs and you get the VCs to bring you in on their deals. The problem is that everybody tries to do that, and so the only deals they share with anything other than their besties is garbage. So you get a lot of adverse selection there. So like if you're not a best friend with the VC and they're giving you a deal, most likely they're giving you their crap, and that will work out probably not so well.
How interesting. Make friends with founders, always a good strategy. This sounds very mercenary, but when you're making friends with the founder, helping them out, do you contract a little thing? Like, if I can get you a lead VC, then you get
I don't do it that way, because that quid pro quo is just really problematic on many levels. Yeah. I tend to be, sometimes I'll be an advisor, and usually what I'll do is when I first meet a founder, I'll help out a little bit, and then I'm like, they're like, then if they want more, they're going to come back for more. And then I'm like, great. You want my help? I need to be an advisor, because what I say is like, look, if you succeed, I want to be happy with you, not bitter that I didn't get to be along for the ride. And that's worked out really well for me. I have a number of companies that I advise that have had good outcomes, and I'm happy when they get a good outcome. And then I help out, as much as I can as an advisor. But if I'm not doing it as an advisor, I'm always happy to make capital introductions for good companies. So like if a company's good Like legitimately, like I think that the people that I'm sending it to will be excited that I'm sending it to them. So the VCs are going to be like, this is a good deal. Thank you for sending me this deal. Then I'm doing a favor for my friends who are VCs, and I'm always about doing leveraged favors, which is like when I can do something that costs me very little in terms of time and energy, but gets me a lot of like leveraged value, like doing a podcast, right? Talk to you and multiple people hear it, that's leveraged. But like if I'm just going to like, a lot of people reach out, they're like, hey, I want to pick your mind about whatever. And I'm like, that's not leveraged. Like I got like one by one, I got to talk to people. I'm like, go watch all my podcasts. Like
Right.
if at that point, then you have some questions, feel free to email me. But like, yeah. So leverage favors, that's everything. I'm always looking for those. Leverage is everything in this business.
I like it. Leverage favors is a great phrase. Excellent. All right. I'm going to go back to your story a bit. So you're doing syndicates, and then at some point you say, I want to go raise my own actual proper venture fund. When did that happen? When did that light bulb go off? How many syndicates had you done? I guess when did you know you had a track record that you might be able to raise a fund on?
So what happened actually kind of happened by happenstance was I had done, so the ramp was like 1 million of syndicates in 15. I think it was like 3 or 4 in 16. And then in 17, I got introduced to these guys called Industry Ventures, and they're a big fund-to-fund secondary fund. And it was literally the first LP meeting I ever had. And I go in there and I'm kind of just telling them my story. And I wasn't even raise capital. I was just like, this is like, I'm just getting to know, a player in the ecosystem. And
sorry, is industry a VC or an LP?
They're both.
Okay, got it.
Yeah, so they're a fund of funds, an LP. So they invest in lots and lots of venture funds, and they're also a big secondary buyer, and they also do direct investment. So it's a multi-billion-dollar institutional firm. They're probably one of, if not the smartest group in the entire valley who sit where they sit in the ecosystem. And so at the very end of that conversation, I mentioned, I was like, oh, by the way, I'd written a term sheet to give a bridge to the Helicon guys, who I've been an advisor for many years. And Brad from Foundry found out. He called me up. He's like, hey, do you mind if we make this a B? And I was like, it would be my honor to, if you come in and turn my little term sheet into a B, I'd be excited about that. And so I was co-leading this B with the Foundry guys, and I had this big allocation, much bigger than I could fill. And I was like, I don't know how I'm going to fill it. And the industry guys were like, oh, well, we used to do this thing with Saka, where he would find a deal, he would bring it through our committee, we'd fund it if we liked it, and then we'll give you carry on that, and we can write bigger checks than you can get from your syndicate. And I was like, cool, let's do that. And so we started working together on that basis in 2017. And then deploying capital into a number of other opportunities that bigger checks were possible. And it was kind of like a fund on training wheels, because their committee was still there. They still looked at the deal. Like I couldn't just do whatever I wanted. And we kind of built out a track record that way over 2017, 2018. And then I got lucky. Dropbox bought Helicon, and when that happened, they thought I knew what I was doing, and they gave me a lot more rope to go hang myself with. And so it was like that. Like at each step of the process for me as an investor, it's been sort of like try to figure out how to get access to capital to build a track record, and then leverage that to more and more and more, so that over time the track record accumulates, but I can keep deploying, keep doing the work, as opposed to a lot of people kind of do it, I think, in a very ass backwards way, which is they're like, oh, I'm going to go raise a fund to go build a track record. And the problem is when you go try to convince somebody to give you capital to raise a fund, when you don't have a track record, you spend a shitload of time doing that, and it's a real pain in the ass. So I've always tried to do it the other way around, which is like, how can I hack the system to find access to capital to build a track record to make it easy to go raise the funds when the time comes?
Interesting. Yeah, good stuff. So let's talk about that then. Let's kind of move the timeline forward to raising that first fund. And how much was it? And then who was involved? Talk about the process of doing that first fund.
Yeah, so the first one was a very small angel fund on AngelList, and it was just $1 million. And a number of folks who were backers of mine on AngelList contributed. Some friends of mine contributed. One of the AngelList sort of like captive funds contributed. That was my first fund, Blind Pool, and I wish that one was bigger. It's like currently we're 1x on DPI, so we've returned all the capital. We're 10x on TVPI, so like on paper we're going to be in a very good place. And then it's got a bunch of good companies in it, including Mercury. So I think it has potential to be even 10 times bigger than it is now. So I wish that was like a bigger fund than like a little $1 million fund. But on paper, everyone is very happy with that. That was my first fund.
Yeah.
and that was just $1 million in 2017 and 18. And then so after the industry guys basically they were like, at one point they were like, we're going to make you an offer you can't refuse. And I was like, sweet, I guess yes. And they're like, what we'll do is we'll do 2 funds with you. We're the sole LP. And I was like, oh, okay, that's cool. Let's do that. So we put that in place. It was a $45 million vehicle, 2 vehicles. We put that in place at the end of 2019, and I started deploying off of that. And then we pretty quickly realized that fund was the early stage part of that was too small. And so in 2021, I went out and raised a proper early stage fund with a whole bunch of LPs. And so that's now I basically I actually run 4 vehicles that I'm currently deploying off of. My early stage main fund, which is $33 million. My rolling fund on AngelList, which anybody can participate in, which is about $4 million a year right now. And then I have a $30 million opportunity vehicle. And then the AngelList Syndicate, I still try to bring in as much as I can whenever I can find a deal.
Wow. Rolling fund, the Syndicate, the 2019 fund, which was 45.
Yeah, well, that's mostly deployed and it's split into 2 parts. So the early stage vehicle is deployed, and then the opportunity vehicle of that is I'm still deploying that.
And then the 2021 was from
that's what I call my main fund, but it's a $33 million early stage vehicle that I raised in 2021.
Got it. Interesting. Are these, how do I put it, synergistic? Are some of your syndicate deals coming and flowing into the
Yes. So the way it works is it's very simple rule set. So any early stage Series A and earlier deal, my main fund and the rolling fund, they must have as much allocation as they can get up to proper portfolio construction sizing. And so they go first. But then if there's additional allocation, then I can bring in the syndicate and potentially the opportunity fund. And then anything that's Series A and later deals, B and later, then the early stage funds, they tap out, and then it becomes the syndicate and the opportunity vehicle for later stage stuff.
Got it. Interesting. And are you a solo GP? I think.
Yeah, it's just me. Yeah. I'm the only investment professional. There's a great woman who helps me out on back office stuff, finance person, and she's amazing. But yeah, all the investing stuff is just me.
Was that by design, or did it just sort of happen that way? Or
But I think there's real advantages to being a solo. It's interesting. This is a business where all the money gets made by contrarian, non-consensus, weird ideas consistently over and over again. And yet the whole industry has sort of settled on this committee decision-making process because that's kind of how historically they've always done it. And so you have these committees making the pretty shitty decisions in my opinion. And so I can counter position against them and do things that they struggle to do, both in terms of speed, in terms of stage, in terms of type of deals that I'll do. There's a bunch of ways for me to basically live outside of sort of the traditional VC sort of crowd that all gloms together all the time.
Yeah. What's the downside of being a solo GP if there is one?
I mean, you're by yourself, right? As long as you're making good decisions, you're doing great. But if you suddenly start making bad decisions, you got a problem.
No one to blame.
Helpful to have somebody next to you being like, "Yeah, that might be a dumb idea." On the other hand, some of my really dumb ideas have turned out really well. So I do think there's some value to making idiosyncratic decisions, and doing it by yourself often is you end up with more idiosyncrasy than you do when sort of modulation of a committee. That just sort of drives everything to mediocrity oftentimes. Very rarely. And the other problem you have is that with these committees is that the interpersonal problems break down all the time. And so these funds are just a mess, a hot mess of interpersonal feuds and disagreements and politics. And so I think there's real advantages to being a solo.
Yeah. How do I ask this? Touch on the idiosyncrasy. I can't even pronounce the damn word. The idiosyncratic nature of this, and how do you have an example of that?
I'll give you an example. So, what year was it? Let's say 2018, maybe 2019. I had been advising these guys who were founders of a company doing SDRs as a service. Great team, really hard market, and they hit a wall and they shut the company down. And the designer on the team is like, "Fuck it, I'm going to go to paint." And he just wants to take a break. So he goes to Goa, and he's really into mushroom tea. And mushroom tea is great for you, except it tastes like shit. So really good for you, great way to stop drinking coffee. It's got all these wonderful adaptogenic properties. Like we should all drink it every day. It's terrible tasting. And so over there, he gets into the Goa chai tea blending techniques where you add cardamom and keiko and black pepper, and they do it with chai tea, but he does it with his mushroom tea. So he comes back and he's got this blend he calls, this looks like literally it's a very muddy sort of thing. And his friend's like, this is great, you should sell it. And he's like, okay. So he makes a brand, he puts it up on Shopify. First month he sells $5,000 worth of tea. Next month he sells $10,000 worth of tea. And so then they reach out, him and his buddy from the last company reach out. They're like, hey, you have to help. And I'm like, I don't know anything about CPG. I don't know anything about tea. I don't know anything about consumer. Oh yeah, let me help. So I like pinged a bunch of my friends who were CPG people, and they're like, oh, this is the best deal ever. You should do this deal. And I'm like, guys, I don't know shit about CPG or mushroom tea or anything else. So then the next month they sell $20,000 worth of tea. And they're like, hey, help. And I'm like, dude, I'm helping as much as I can, but I'm not useful here. The next month, they sell $40,000 in tea. And so you got 100% month-to-month growth, direct-to-consumer, super high margin, beautiful product. And they're running out of capital because they're running out of inventory. And I'm like, fuck it, I'm going to do this deal. Why not? Like, here's a $500K check, bought effectively 10% of the company, and I'm sure to lose it, but I got enough other positions that it's nice to play at the edges. Like the edges are where a lot of interesting stuff happens in this business. And so it's like, go for it. I think they very well could sell $100 million worth of tea this year, maybe more. I mean, it's called Mudwater. It's a great product. They've done fabulously well. It's a great business. It looks like it'll be a great outcome for me. So like that's a real idiosyncrasy. Like, and yeah. I've got a bunch of examples like that. It turns out that the decisions that I make at the edges have tended to be where my biggest outcomes are. So like Cruise, self-driving car company, like that was all founder bet. But like, I don't know anything about self-driving cars. Like I'm not an expert in that level of, but the founder's amazing and I've known him for a long time. And I'm like, okay, we'll take a risk here. So
that's awesome.
Yeah, I think the edges are where a lot of interesting stuff happens in venture.
I would agree with you, although like we've had 30,000 startups on Founder Street, and I see 28,000 bad ideas too. So I guess how do you decide between what's on the edge and what's just weird and bad? But yeah,
you have to. It has to be both. Like I think, I think what's interesting is that like what I'm looking for is things that are weird but viable. And that's a hard mix. Oftentimes they're weird and not viable, but like when they're weird and they're viable, or they're weird and potentially so for instance, when they first started Uber, Travis and I were at a party and having a couple beers, and he was telling me about the idea. They hadn't even launched yet. And I was like, dude, that's going to be so awesome. Except I was like, but the taxi lobby is going to fuck you. Like, you're no way you're going to get through that. And like, he's like, I'm a fighter. So we literally argued for like 2 hours about whether or not he could make it work or not. And it taught me a lesson, right? Which is that like, when you see a company that like has the potential to add an incredible amount of value, but there's some idiosyncratic reason why you don't think it will work, or something that like makes it weird or whatever, those are the things you really should lean into. Like not, you should at first like, no, it won't work because, but whenever your brain's like, but, then you really need to spend a little more time there.
Interesting. Did you put money in Uber?
I wasn't investing at that point. No. I used to play poker with the Airbnb guys, Dropbox guys, like the Reddit guys. I mean, I all these times I was not investing. I wish I had been. I would have been.
Sure. Well, you got Mudwater. It's funny. I've got the YouTube ads for Mudwater like constantly in my YouTube stream for whatever reason. Never tried it, but
if you ever want to stop drinking coffee, it's a great solution. Like, so, like I use it in the afternoons. I love coffee, but like, come now, I should stop drinking coffee so I can get some sleep tonight. And, I'll have some mud, and it just like, it's a great coffee replacement. And if you want to stop coffee completely, or for health reasons, you need to stop drinking coffee, you'll find Mudwater is a very effective solution for that.
Interesting. Cool. Let's see. What else do I want to touch on here? Maybe let's go into a little bit more on that, raising that $33 million fund. How did you identify LPs, source LPs, talk
Yeah.
about the process for herding all the cats, all that stuff.
Yeah, so my story is not normal. One, I had, by that point in time in 2021, I had 6-year track record and, have returned tens of millions of dollars to my LPs. So, a bunch of big outcomes. So I went into it with a lot of advantages that made it a lot easier. And I raised it in 2021, which is like, there's never been an easier time to raise capital. So it ended up being, literally, it's kind of a joke amongst my friends about how easy that fundraise was. It took 3 weeks for me to raise that fund, all over Zoom, not a single in-person meeting. And it was, literally, I would reach out to my VC buddies, being like, "Hey, here's my deck. Here's my list of companies and their marks, and who should I talk to?" And they're like, "Me. I want to invest in this." And they literally invested without even taking a call. And so it was like 2021. It was an amazing time to raise capital. But I think the lesson was, like I said before, is that like figuring out how to get that track record really made it a lot easier when the time came to raise, because a lot of times people get tripped up on like, being good at other things and being good investors are not the same thing. And so a lot of people get tripped up on that. I was like, you may be a really good founder. Are you a good investor? We don't know. And then, it's very hard if it's a qualitative judgment by the LP. They're like, well, I'm going to talk to you and ask you questions, and then I don't know if I believe you or not. It's a lot easier when we're like, here's my spreadsheet, take it or leave it. Yeah. So
I love it. Yeah. Here, instead of a pitch deck, here's the spreadsheet. Yeah. Did you have a specialized thesis? A lot of emerging funds, newer funds have a real kind of niche focus, or were you more idiosyncratic deals? And here's my track record.
So yes and no. I have 3 buckets that I spend my time in. One is founders I know really well. So I've been in the Valley for 20 years. I know a lot of people really well. Those are easy deals for me to do. They tend to be, performance-wise, they've done very, very well in my experience. They tend to also be limited in allocation, because usually at the point that I've known somebody for a decade, everyone else does too. And so, like Ahmad for Mercury, it's a great outcome. Super happy that I've been able to invest in that company over the years. I wish I had been able to put in more, but there was a lot of people who wanted to invest with the mod because the mod's really good. And that's kind of happened over and over again in my experience. So I get a certain amount of deployment there, but not as much as I'd like. The second area I spend a bunch of time in is spaces that I'm really smart in. So it used to be I was an ad tech guy, so I spent a lot of time in ad tech, martech, data. I'm finding my edge there is slowly degrading over time. So I'm not like super smart there anymore, but like it's a space that I can look at stuff and make real qualitative decisions about the idea. And then the third area that I spend almost all my time in is sort of there's an interesting space in the market for the first hint of product market fit, which is like, the founder goes, they raise some capital, they start building, they go to market, they iterate, the messy middle of trying to figure out how to get something to work, and then they find it. And really what happens is there's a crystallization of the value proposition where it goes from being, when you talk to a founder and they're like, well, we do this and they're just like, they just kind of throw a bunch of features and functionality and capabilities at the wall to see what will stick with that customer. And then when they find it, they're like, oh, no, we do this, period, stop. That's what we do. And if you don't want to talk to me about that, then great. Let's not waste my time because I'm busy, because I have a lot of people who want to talk to me about that. And that value proposition, usually if you find it and you identify it early, it usually precedes the sort of month over month growth rates where the VCs will then show up and, extend the line and write the big checks. And so if I can find the point the value proposition is a qualitative before it becomes quantitative, where you really crystallize the value to the customer, then, they always want capital then, because they're like, oh my God, I want to go. Let's throttle. We got it. And usually the VC, the committee run VC process takes another, more data points before the VCs are going to be willing to do the deal. So that's where I like to find stuff and get involved.
Yeah. Interesting. How many LPs did you end up with in that fund?
In the main fund, there's 55, 60. Some fund to funds, some multi-family offices, a bunch of individuals. But like I said, the fundraise process took 3 weeks. It was like, so I would literally get introduced to these institutional LPs, and I'd be like, oh, by the way, we'll probably be done in like 2 weeks. And they were like, we couldn't do a deal in 2 months if we wanted to. And I was like, okay, well, see you next time. Which is great. Raising capital from people who are closer to the game has been very nice.
Interesting. So that was 2021, peak time to do that. since then, or even starting then, we've seen a ton of new emerging fund managers come out. I saw some statistic, I don't know what it is, but it's like hundreds, maybe thousands of new venture funds being formed.
Yeah.
And right now it's 2023, halfway through the year. What advice do you give? Here's where you can do your leveraged favor. What advice do you give to emerging managers now in this market? What do you tell people? Want to pick your brain?
Good luck.
Yeah.
It's so hard to raise capital right now, from what I understand from the people that I talk to. I mean, like I said, like, you can spend your time raising money or you can spend your time deploying money. I'd rather spend my time deploying money. So for me, and the advice I give all of these folks is, I'm like, figure out how to get access to capital and deploy the capital, and don't spend all the time trying to raise the money to run the perfect blind pool that is this magical unicorn that we all, aspire to, but it takes a long time to get there. So, there's a lot of hacks for doing that. For instance, like, a lot of family offices want to do direct investments, but they don't know how to do it. Well, you can work with them to help them do that via SPVs, where, you find a deal and, you bring it in and they look at it and evaluate it alongside you. And, then you get carry on that. There's obviously things like AngelList. There's all these VC funds that are always looking for good, high quality deals. So, you can bring them a deal, and then if they do the deal, they'll give you some economics on it. There's a lot of ways to hack the system. And I think I always recommend that's the better path than slogging it out trying to raise in a market like this, because it's really hard.
Yeah, here's my little tiny product plug. We launched fundingstack.com for any emerging VCs. Check it out. But we're already getting some pretty good numbers on there, but everyone's struggling. Like, everyone's really having a hard time right now.
Yeah.
And one of the questions that keeps coming up is, should I be going after family offices? Like, a lot of attention and excitement around going after family offices. I think there's a perception that that's maybe an easier LP market to crack. Yeah, any thoughts just on, like, kind of where to point your energies? I mean, it sounds like what you're saying is find good deals first, figure out how to get them funded.
Yeah.
But in terms of, like, if you have a certain number of hours per day to pursue LPs, what type of LP would you recommend people concentrate on?
I mean, honestly, like, in my experience, it's very relationship driven. So it just takes time to do that. And so if you think about it transactionally, like, hey, I want to go find the right LP, and I go talk to them and they're going to give me a check, I think you're going to be very disappointed, unless you have a track record, or you're, a super duper expert in a space that everyone's fired up about. So you're an AI expert, and there's a reason why they all want to get exposure to the AI space, and, like, you can get them that way. But I think approaching it transactionally, especially in a market like this, it's going to be really frustrating and painful. I mean, for instance, with family offices, right? Yeah, they do write checks, but a lot of them love to just pick your mind. They're, like, super excited to get you to come in and tell them all about what you're seeing in the market. And then you're like, thank you for that free hour consulting. Bye. So you can spend a lot of time going down a lot of dark, blind alleys. I'm all about trying to make that fundraise process as easy as possible, and relationships really help that.
Yeah, that makes sense. I mean, I guess one could argue, you've got to start building these relationships in advance anyway. So which relationships should you start to build, and regardless of what form that takes? I guess, I don't know. I mean, you've got some good like industry ventures co-investors you've done deals with that are also LPs, which is nice and convenient.
Yeah, that helps a lot. Yeah, that's you want to find somebody who helps validate you as much as possible, but it's a process.
Sure.
There's no easy answers. No easy answers.
You have a unique fund, and the whole story kind of echoes that, but do you like I feel like there's a lot of these very niche focus, whether it's applied AI, I see a lot of those right now, or is that maybe a way to kind of get the attention of LPs a little bit more, and have something really specific and carve off, build a brand in that space? I'm trying to think of other hacks to kind of get into the venture world.
Yeah, no, I hear you. I mean, look, if the great thing about applied AI is that there's just not a lot of people who are smart in it. Almost nobody is. Everyone's trying to figure it out. So, if you jump into it and spend all your time there now, then you can probably become one of the smartest people pretty rapidly if you wanted to go, become an expert in that. And you see a lot of people with their Twitter threads around AI and who are writing thought papers and who are out building landscape maps and like content marketing effectively. So there's a lot of ways to like go after that. So you see the same thing in climate, for instance. Like climate is an interesting space that people are excited about. So there's a strategy there. It's at the end of the day, though, what I always tell people is I'm like, just do what gets you excited that you enjoy doing, because you're going to be doing it for a long time before you make any money. And so this is I'm 8 years into it, and I can easily see another decade in front of me. And so it's like, okay, you better like this job. You better like the work you do. And so I always subordinate the tactics that I use to the things I get joy out of. And people is where I get my joy, meeting people, talking to people, ideas about how to communicate. I enjoy the process of trying to figure out how to articulate ideas, understanding complex things. Like I enjoy the learning process. That's where I spend all my time, and it seems to work.
Okay. You can either punt on this question or answer it any way you want, but are you already thinking about the next fund? Is it going to be a big fund? I mean, it seems like there's a common pattern, right? You raise a $30 million fund, $50 million fund, and the next one's 100, then it's 250 and 750. Or do you see that in your future?
Yeah, or the other way, like you can look at the homebrew guys, and maybe they went the opposite direction, and they just started saying deploying their own capital, and they're you get 100% of the gains, and you spend this probably less time and energy at it because you don't have to deal with LPs, and it's a lot easier. The thing, the sort of ceiling that I see that I haven't decided if I want to try to break through is sort of like once you start to compete directly with the big VC firms, there's a lot of adverse selection there, because now you spend the time to get to a yes in your own head on a deal, and then you win it some fraction of the time. Whereas now I win almost every deal I want to do because I'm kind of in front of them and it's earlier. And for me, it's more about finding the deals that I want to do. Winning the deals tends to be pretty straightforward. And so like, as you start to deploy more capital, then it becomes much more competitive from that perspective. And the question then is, do you want to do that? And also building a firm, do you want to hire and manage a bunch of people? I don't know. We'll figure that out when time comes. Well, yeah. Right now, it's like there's enough work to be done for the next few years. So, yeah.
I like it. I'll let you go. I know you're busy. One more question, maybe two. Any other tips? Part of what I'm hearing as an underlying thread is you've been able to hustle good deals, and you've been able to build on that in many ways. What are other tips for someone new, maybe even new to Silicon Valley, or maybe someone, new to this world, that how do you get good deal flow? How do you insert yourself into that where you're playing poker with the Reddit and Airbnb guys?
Yeah. I mean, like I said before, honestly, like the strategy is just do leveraged favors. Like if you're out there doing favors for people where it doesn't cost you much, you're sending an email, you're making a connection, you're giving them some advice, you're doing something that's super valuable to them, but doesn't cost you a lot of time. You can pay it forward all day long, and you don't feel like you're getting taken advantage of. And that, at least in my experience, has come back in spades for me in terms of access to deal flow and getting to be in the right rooms. Because if you're somebody who's always useful, then everybody's going to want you in the room. Like everyone's going to be excited because they're like, hey, we get her in the room and she's going to provide a lot of value to all of us. Like, let's invite her to more things. So I'm always trying to figure out how to do that. That's, and it's a process, it's a journey, but yeah, I've enjoyed it.
I like that. Okay. Very last question, I promise. What advice would you give your younger self going back, 8 years, or what is other advice that you give, newer investors, fund managers that we haven't covered?
I mean, I don't know. It's a good question.
Somehow get the.
Like one experience I had was I looked at Bitcoin and it was like 50 cents, and I was like, this shit will never work. And in reality, that was obviously factually incorrect. And then also the decision-making process was wrong, because what I should have said is, what is the probability that this is going to work? Let's call it 1%. If it works, how big will it be? It'll be really big. So, I should have been like, okay, this is unlikely, but potentially huge. And I think that lesson is, for me, it's about risk. And it was kind of the first thought that came to mind was that, like, I would tell my younger self that, like, you should look at risk and embrace the big risks at a young age, because oftentimes that's where the most interesting stuff happens. Like, everybody sort of looks at the stuff that is going to work for sure. Everybody's on the NVIDIA trade right now. It's going to work, obviously. Nobody's overdoing something weird. And so, like, the more you can gravitate away from where everybody else is to the places that are weird and uncertain and risky, and like that's where you're going to find the most interesting stuff. And so, I was, of all the mistakes I've made in my career, the ones I regret tend to be the ones where I dismissed something too quickly, as opposed to being thoughtful.
Good. Excellent. All right. Well, if people want to learn more, get in touch with you. I see on your website you have, like, submit a pitch or something that goes to an email. Do those actually go anywhere?
Yeah. No, I mean, I get a lot of emails. I don't respond to the ones that I don't know the person, but every now and then I'll fund one. I've funded a couple that I've gotten randomly. So yeah, my email is shared. If you go to my Twitter, Zach Coelius, that's a great way to engage. But also I have my user manual in there, and that actually explains how to work with me, because I'm kind of a weirdo sometimes, and I highly recommend everyone read that before they try to engage with me. Yeah.
I like that. So so go to coelius.vc is the website, but then really the Twitter is where to find out, how to your operating manual, how to get in front of you, and all that good stuff. People
and like every other VC, I'm there every day. So if you need to find me, Twitter's a good place.
Cool. Awesome, Zach. Thanks so much. Good to see you again. Exciting to hear the whole journey and tale here. I've kind of seen you out and about. I've seen you build your career, but it's fun to hear the actual story from the horse's mouth. So.
Great. Thanks for having me. I really appreciate it.
Good stuff. All right. We'll catch you after your next fun. How about that? All right. Over now. Bye.